Since 1950, the yield curve inversion has predicted every single economic recession. In today's video, I'll show you how to build your very own powerful tool using the free TradingView platform. Let's jump right into this video. Before we begin, I'm going to help you get some more information on what exactly the yield curve is and what it means for it to be inverted. I've got two resources to share for you. Number one, we created a video on how to use the yield curve and its predictive power in the stock market. To watch this video, click the notification above. The second resource that I want to share with you is our blog post. We just posted a blog last week on how the yield curve inversion works, and we did case studies with all major economic recessions in the past. To see this research, click the notification above once again, and that'll take you to our blog post. Now let me get started by showing you how to build your very own yield spread using TradingView. We're going to start with the chart of Apple. In TradingView, this chart type will look familiar to you. So we're going to begin to build our bond yield curve from here. First and foremost, I like to start by creating a line chart. So at the top, you'll see a candlestick, and if you click this, you could select line. I like the line chart to show trends a little bit more clearly. The next step we're going to do is explain what type of bond yields you could view. On TradingView, the symbology is as follows. You click on the symbol and you'll be able to type. So if you type in US02Y, as you type, it's going to give you the instrument on the bottom. So if you click this instrument, what you're now looking at is the 2-year US Treasury bond yield. Now, if you zoom out, you could see a trend overall that yields have been going up since about 2018. These bond yields move very correlated with the Federal Reserve interest rates. Also, bond prices will move inverse to the actual yield. So if bonds are going down, you would expect the yield curve or the yield rates to be increasing, and vice versa. If you wanted to look at a 5-year yield, you'll type in 025Y, and that's a 5-year yield curve. And what if you wanted to look at the difference between two different bond yields? You could do this on TradingView by doing the following. One of the most common and frequent viewed yield spreads are between the 10-year and the 2-year. So what you would want to do is subtract the 2-year yield from the 10-year yield. And this is how you could type that into TradingView. You could type in US10Y, which is the 10-year Treasury bond yield. Type in minus US02Y, which is the 2-year Treasury bond yield. And if you hit enter, you're going to see something called the 10 and 2-year spread. This is what we talk about when we say the yield curve inverts. This means that the 10-year is dropping in yield as the 2-year is going up. And the trend has been like this for a very long time. Now, if we wanted to switch to a weekly chart and compare that to how it looks with the S&P 500, we would simply zoom out. On the very top, click compare, this button right here on TradingView, and the S&P 500 is already one box that's available for you. So as we click that, you will now see the difference between the yield curve and the S&P 500. Now let's look at an example of this and go back to a previous recession. I'm only going to show you one example in 2008 and 09 because I'm going to give you some resources shortly that you could really look into these case studies and find out how powerful this tool really is. So if we scroll back to 2008 and 9, you could see that the S&P 500 here in orange had been climbing up from 03 right into the 2007 and 2008 market crash. But while we were climbing up, we were actually experiencing an environment of a declining yield curve, which means the front end of the curve or the shorter term bond maturities were increasing in rates faster than the 10-year. On this chart here, this is characterized by a decreasing 10 minus 2-year spread. You can see that since 2004, the yield continued to drop on the long end and increase on the front end, causing the spread to decrease lower. When it eventually inverted and hit a bottom in 2006, it took just 12 months for the S&P 500 to sell off. One more way you could use this to analyze the yields is to do the following. You could go in and look at the longer dated bonds versus a bit of a shorter maturity. And you could change this to suit your trading strategy however you like. So on the top end of the symbol box, we're going to type in US30Y minus US10 Y, and that's the 30-year minus the 10-year yield. One more thing you could do here is create 3 different line comparisons on TradingView and plot the 30 minus 10-year spread and the 10 minus 2-year spread versus the S&P 500. This way you'll be able to closer analyze the relationship between the 3 and decide which one has more predictive power. But the 10 minus 2-year yield is what's used most traditionally in the industry. This is a very important spread tracked by all institutional managers and traders. So now I invite you guys to go in on your TradingView and play around with these tools and come up with something that works for your trading approach.
All right, trade pros, and there you have it. Now you know how to have one of the most powerful tools used by institutional investors. It's an amazing tool, and while it doesn't help you decide what to buy and exactly when, it's a greater, bigger picture perspective of the overall economic cycle. And it's important to use it as a map or a GPS. And even though you could take little detours to get to your final destination, this yield curve shows you the big picture and the route map to where we might be headed. I'd love to hear how you incorporate this in your trading strategy. Leave me a message below and I'll jump in and answer all of the comments. That's all we have for today. Please share the message with your friends and help us spread the word on this awesome community we're building on YouTube, including yourself. We love having you here. Thank you for tuning in. To get our free 6-lesson trading course, click the link right here and get your copy. And also don't forget to click here to subscribe and hit the notifications button so you know when we have new content coming out. I want to thank you for watching. Have yourself an awesome day. Manage your risk and trade like a trade pro. Take care and goodbye.